The stock market's trajectory has been a hot topic for months, with predictions swinging between extremes. But just 72 hours after JP Morgan CEO Jamie Dimon parted ways with the firm's chief market strategist, Marko Kolanovic, who had predicted a bearish market for the last 18 months, a new narrative has emerged, one that could change everything for investors. Asa, a renowned market expert known for his cautious yet insightful views, just dropped a bombshell on CNBC. The market is not on the brink of collapse. In fact, it might be just the opposite. The Magnificent seven tech giants, including Microsoft, Meta, Nvidia, and Google, have been driving the market's incredible growth. These companies are not just speculative tech stocks, they're the new value stocks, and their consistent earnings, growing margins, and impressive cash flows back that up. While many people worry that these companies' massive gains might signal a bubble, Asa makes a strong case that the fundamentals are there. He points out that the total market cap of these 7 companies alone has surged by an astonishing $8.8 trillion over the last year and a half. This isn't just a passing trend, these are businesses delivering real, sustained growth. Looking closer at these companies' valuations, it becomes clear that the fear of a bubble might be overblown. For instance, Nvidia, often seen as the most volatile of the group, has an impressive 200% increase in revenues, and yet its forward price-to-earnings ratio, PE, of 34.5 isn't all that out of line compared to past market conditions. In fact, Asa argues that when you consider their earnings and growth, these companies are not overvalued. Google, for example, is trading at a forward PE of 22, which, by today's standards, is reasonable given its 12% revenue growth. Similarly, Meta and Microsoft are seeing substantial gains, with PE ratios of 24 and 35, respectively, yet both are still growing at double-digit rates, solidifying their position as fundamentally strong investments. This isn't the same market as 1999, when speculative stocks were pushed to unsustainable heights based on hype alone. Asa points out that the current environment is much different. Back then, we saw a plethora of unknown companies soaring based on promise, not performance. Today, the companies leading the charge, Microsoft, Meta, Nvidia, are making money, generating profits, and maintaining solid margins, proving that they're not just story stocks but reliable earners. So, what does this mean for the future? Asa believes that the current market setup mirrors the conditions of 2005 to 2006, right before the market saw its next big leap. With a 5% interest rate in place, there's a natural lid on explosive market moves, but this is actually healthy for the long-term sustainability of the market. And when the Federal Reserve eventually lowers rates, we could see an even greater push upwards. Despite all the noise from mainstream media about an impending crash, Asa argues that the market is in a strong position. If anything, this could be the start of a new bull market. What's more, even if we do face a correction or a brief downturn, the overall trajectory remains positive, with the S&P 500 up by 20% since December 2021, even without the explosive gains of the Magnificent Seven. So, while we can't predict the future with certainty, the data is clear, the market's bullish sentiment is grounded in real growth. Investors who understand the importance of sticking to solid, long-term strategies, like dollar-cost averaging, DCA, are well-positioned to ride this wave. The quick money chasers might get burned, but those who stay patient will reap the rewards of this incredible market transformation. As we look ahead, it's clear that the bull market might just be getting started. The media might throw up clickbait headlines about impending doom, but in reality, we could be in for one of the best stretches of growth in decades. So, if you're still questioning whether it's time to jump into the market, Asa's insights make it clear, the risk isn't as high as it seems, and the rewards are substantial.